Well, good afternoon, everyone. Welcome to this week's Mortgage Minute. My name is Art Alvarez with Mortgage Works, where we have the answers and they're on the house. There's a couple of things we're excited about today. Of course, we're coming to you from beautiful, sunny Palm Springs, California, the greater Coachella Valley area. And one of the things we're excited about is the forecast is we may be below 100 degrees going into the weekend. That's great. We haven't been under 100 degrees since before summer started, so that's always good news out here. Of course, it'll probably go back up. In fact, it is going to go back up into the low 100s next week. The other thing, though, that we're kind of excited about is rates are hanging in there. Now we're off our lows a little bit, but mortgage rates are still very, very good, relatively speaking. And so, of course, I'm going to go into that right now and give you a little bit of an update. The first thing, of course, is we'd like to give you an idea of, what our rate grid looks like, and where we post interest rates for, typical programs conforming 30-year fixed, 15-year fixed, FHA, VA, jumbo, and so on. And you can see it there as Jeff pulled up. We're hanging in there just a little over 6% on a conforming conventional loan, still in the mid low fives on the FHA and VA. And by the way, one of the things I want to point out to you is check that about mortgage rates at the bottom right when you get a chance. Go to our website. We've updated that now, and we're going to have a video that basically replaces the text that I had on that page. So I think it'll be easier for you to follow along and get a better grasp of how these mortgage rates are determined day to day and how they can change from day to day. So with that, I want to go ahead and just going to show you the current chart for the 10-year bond yield. And again, this is a 5-day chart. It goes back to last Friday. And you can see we had a nice little trend there going into early mid this week, looking really good yesterday when the 10-year yield got down to about 3.77. That was a pretty good number in terms of where it was at. That was as low as what we saw late December after Christmas. But of course, today we've had this little bit of an uptick. It's about a 10 basis point uptick in yield. And so that's why after yesterday, we were briefly being able to quote a 5 7/8 rate with no points for, a good credit score and like a 25% down payment for a conforming loan. Now with this change in the bond yield today, we're back up to 6%, but still very good. As I point out all the time, you watch CNBC and they give you the morning rate quote as where mortgage rates are, and they're still talking about 6.4. But nope, you can get a lot better than that. If you need more information, you certainly should get in touch with me. So in terms of what's going on this week, in terms of economic data and financial news, a pretty light calendar as far as economic data points. In fact, a very light calendar. However, what was the first thing that kind of made some difference in the market was the Fed minutes were released for the July meeting. And what those minutes revealed is that several of the Fed officials declared in that July meeting that it's time to lower the Fed funds rate. And they were discussing that should happen first time in September, only about 3 weeks away. And the other thing so from that perspective, I think the Fed and the Fed officials are finally feeling like some reduction in the Fed funds rate is justified. Part of what was discussed, FOMC, by the way, is Federal Open Market Committee. They're getting more concerned about the labor market, getting a little more concerned that it's getting soft. And of course, today's news, it kind of underscores that, was the big oops, I call it, when the Bureau of Labor Statistics had a press release and announced that, we're almost $1 million jobs off from March 23 to March 24 in terms of new jobs added to the economy. So they had to do a restatement of how many jobs were added during that 12-month period. And it's almost 1 million jobs less than what we thought previously. So, of course, that probably also is going to be fuel to the fire with the Fed and being a little bit more concerned about how's the labor market, is it starting to soften up. Today, we had initial claims for unemployment benefits. Forecast was 230,000. Last month, it was 227,000. And it did come in even slightly worse than forecast, 232,000. So again, a mild, slight signal that maybe the labor market's softening just a tad. And of course, the labor market, I would argue, is probably what the Fed is focusing on more than anything. And then for the rest of the week, there's really not much on the calendar. There is existing and new home sales. Existing home sales did come out today. pretty much as forecast, 3.95 million, a slight increase over the previous month of 3.9 million. Tomorrow will be new home sales. And again, the forecast is for new home sales to be up slightly, not by a bunch, but just slightly. And then the only other thing that could move the market is tomorrow, Fed Chairman Powell is giving a speech in Jackson Hole, Wyoming. That's an annual, economic conference type of an event. He will be giving a speech there tomorrow. In my opinion, to the extent that that could move the market in any way in terms of rates, I think the bias is on the negative side. In other words, it's already baked into the market that we're going to have a reduction in the Fed funds rate in September. I'm going to predict 0.25, a quarter percent. Some forecasters are suggesting 0.5%. I'm not seeing that. I think it's going to be a quarter percent. I think that's baked into the markets. And if Fed Chairman Powell basically reaffirms that, I don't think that's going to move us in a lower direction. I think the risk is if he says anything that might undermine the expectation of this September Fed funds rate cut, that could actually send bond yields higher. We could actually see mortgage rates get a little worse. So I think that's the bias. It's more to the negative side than the positive side. And again, remember, I can't say this enough. When they lower the Fed funds rate, if that does happen, that does not mean a direct correlation to mortgage rates dropping by the same quarter percent. It doesn't work that way. In fact, I would argue our current bond yields are already, again, have that baked in. So if that ends up being what's announced in September, I think mortgage rates probably won't move much at all because it's already baked in. And then the last thing I want to point out to you before we get into our discussion with Jeff for this week's subject, Barbara Corcoran saw a news release again this week. She's back in the news. And as we see these rates trickling down just a little bit more, she's back on her soapbox declaring beware that if we do see some lower mortgage rates, and particularly we get under 6%, as the Zillow chief economist pointed out, if we get under 6%, a lot of this pent-up demand we've been observing as to prospective home buyers is going to be unleashed. And what is that going to do? It's going to increase home prices. It's not going to reduce them. There's so much pent-up demand that even if we get below 6% on the rate, and if Zillow's right that that's going to unleash a lot of prospective buyers to hit the market and try to buy a home, that's going to push prices higher, not lower, and that could offset some of the benefit that you're seeing with these a little bit lower rates, even if we get into the fives. So another indication, if you're on the fence as a buyer, I would urge you, now is a good time. We're right around that 6% level. That's basically a normal level historically. So we can help you determine if you can qualify, give you some ideas as to how to make offers with seller concessions, temporary buy downs, and so forth. I would argue do that now, because if we do get a substantial increase or decrease in rates anytime in the near future, that's going to push those home prices up, and it's going to offset some of the benefit of the lower rate. So with that, let's go ahead and bring Jeff back, because we've got some discussion a little bit more that's going to be related to rates, and also how lenders and brokers, mortgage brokers, set their rates.
Well, I thought I'd start off with a kind of fun image there of me holding my head, because this whole thing about interest rates and what brokers charge, Art, it's kind of confusing. And before we get into it, I just want to show you. I did this earlier today, and I thought, yeah, well, let's put a little proof in what we're talking about, a little evidence. Okay. So what I did is I went out and I just Googled and I said, hey, what are the interest rates today? As you can see, it says 30-year fix is 7.107. Now, if I ask you as far as Mortgage Works is concerned, what would you say?
We're 1% below that. Again, you have to take into context based on certain scenarios. Are there some loans that are going to be made at that level? Yes, but there are probably going to be situations where the credit score is not 780, the top pricing tier. The credit score may be 7 or 630. So right, factors like that can affect what kind of rate is going to be quoted. But for a good qualified borrower with a good credit score, that's much too high.
Well, the whole idea is it's why I'm confused, why I'm holding my head, because here's some rates, right? This is published. I get another one. I say, well, let's go to Forbes and see what Forbes is. Everybody trusts Forbes, 6.9. Well, wait a minute. it was just 7. And then if I want to do a 15 year, I've got something there, a 30-year jumbo. In other words, there's another set of quoted rates. Again,
Right.
fairly confusing. So I
Yeah.
thought, well, let me just go to US Bank. Everybody knows about US Bank. The
Hmm.
rate is 6.125. Well, that's a little closer to what you guys are offering, but
Right.
still, it's another, what do you say, a quarter of a point higher or 3/8 of a point higher than what you're charging?
Yeah, basically, although U.S. Bank's quotes, those ones there that you're showing us are pretty good. Although I will point out that's from yesterday. Uh,
Hmm.
and that's one of the things you have to keep in mind as well. Again, we just showed everyone that 10-year bond yield today is about 1/8% higher than yesterday. Yesterday on our website, for a good qualified buyer, that rate on August 21 was 5 7/8 for no points. So about a 1/4% lower than what US Bank is showing, also based on yesterday. So today, if you pull that up, I would predict that wouldn't be 6.125, it'd probably be 6 1/4 or maybe even 6 3/8.
Well, here's the point. When someone goes to the internet and they're trying to shop for something like rates, it seems like every broker out there has a different rate and is confusing because we're thinking, well, is this broker right? Is this broker wrong? Do they have a special way to get special rates?
Yeah.
Are they just teasing me? What's going on? So that's really the premise of what I wanted to talk to you about today is like, this stuff is confusing art for the average person out there who's thinking, I want to buy a home, or as you said before, hey, we've got a refi boom coming. So I'm looking for things like that. I'm keeping an eye on those kind of things. So let's talk about that.
Okay.
Why do we see this fluctuation in rates when I go to broker A, broker B, broker C, and they're all different? And now, if I'm married, I sit down with my spouse and we talk about it, and she says, well, how come they're different? I got no clue, honey. I'm sorry. Help me
Right.
out.
No, that's a very good point. I think most consumers run into exactly that problem, that challenge, and that's why one of the things I always say, and I comment on this in our about rates link on the bottom of our rate grid. If you're going to compare quotes among mortgage originators, I like to say, and of course a lot of us are brokers. Mortgage brokers actually account for about 25% of the mortgage loan volume in the country. So
Mm.
we're a major player in providing mortgage loans to consumers. And so if you're going to compare quotes from a mortgage originator to a mortgage originator, broker to broker, first thing you have to do is we kind of demonstrated here with your previous chart from US Bank, you got to compare the numbers based on the same date, the same day, so that they're all based on the same conditions in the financial markets. But that said, the other big area that causes a divergence in rates offered is mortgage originator compensation.
Hmm.
That the way the scheme works now, and this has been the case since 2010 after the Consumer Financial Protection Bureau was created and took over supervision or regulatory oversight of mortgage originator compensation. What happens now is in most cases, somebody like us, when we deliver a loan to a wholesale lender, we are going to be paid by the lender. We're not paid by the borrower. In fact, when we sign up with that lender, we have to declare what we want for what's called lender paid compensation. And we're given a grid where the spread will be anywhere from, I've seen one lender had it down to 0.5% of your loan amount,
Hmm.
all the way up to 2.5% of your loan amount. And so, as an originator, when we're going to sign up with this lender to send them loans, we have to tell them where we want to be on that grid as to what we want them to pay us. And so with us over the years, we've always been on the low side. In fact, way back when we first started, we were actually at 1.5. And we almost didn't want to do that. We wanted to go lower, but it was funny. Several of the lenders we were signing up with basically urged us not to go too low. Um, but then not long after that, we went to 1.25. Well, more recently, going back to basically the beginning of this year, I went a step further and decided, these days with our average loan amounts, home prices are a lot higher. That means loan amounts are a lot higher. Do we really need to make, on a $500,000 loan, do we really need to make 2.5% of that loan amount
Mm.
to process and deliver that loan? That's a lot of money. That's $12,500 basically to compile a bunch of paper in a file folder and then upload it to the lender. Now, of course, we're being paid for our expertise to make sure that we're providing the borrower the best loan program and terms for their situation. So that's worth something, obviously. But does it really make sense that we need to get paid that much? And because the concern is, are we going to be competitive enough? Are we going to capture enough loans that are potential loans that come to us when we have to give that initial quote? So I changed our lender paid compensation with our lenders, and I took it down to 1%. And that is because we want to be as competitive as we can. And with, again, most average loan amounts, 300,000, 400,000, 500,000. If I can make 1% on that, we have very low overhead. We're specialists. We are focused on that delivery part, that part of the delivery system, starting with, belly to belly with the consumer, the borrower, and then delivering that loan to the lender. So we're very specialized. We're very low overhead. And so, if we can make $3,000, $4,000, $5,000 paid to us again by the lender, not the borrower, that's fine. And it's all a matter of just generating enough volume to pay our bills and, make a reasonable profit. What happens is, and I get reminded of this all the time by the lenders we do business with, most people who do what we do, they go higher on that lender paid comp grid than we do. In
Hmm.
fact, I had one of my lenders call me last week just to double, check in and say, hey, you want to make any changes to your lender paid comp? I said, well, no. Why are you asking? And I said, we're already very low, right? I mean, we're at 1%. And she kind of chuckled and she said, well, yeah, you're right. You're very competitive. And I said, well, tell me something. What is your average broker that you have signed up? What is their average? If you can tell me, what is the average that most of your brokers have signed up with you for lender paid comp? And she didn't give me a specific number, but she said it was more than 1.5%. And so what does that mean to the borrower? I mean, that, everything I'm saying so far, a potential borrower, they're like, okay, so what does that mean? Well, what it means is, when I'm quoting a rate, if I only need to get paid 1% by that lender I'm going to send the loan to, and another broker like us is with the same lender, has their compensation with that lender set up at 1.75% of the loan amount, that 0.75% difference in dollars is significant. And so how does that get absorbed when the quote from the other broker is made? Well, they have to quote a higher rate, because these days,
Mm.
when most every loan that's made, I would argue, is probably going to be a 0-point loan. And so if
Can you tell us what that means, Art? A 0-point loan. What do you mean by that?
yeah, a 0-point loan is a case where you're going to get a loan from a lender, or get a loan arranged by someone like us, a broker, delivered to a lender, and you're not going to be paying any points for that rate that you're being quoted. Most borrowers these days don't want to pay points. They don't have the money to pay the points. And frankly, it's not economic for them to pay points to lower the rate a little bit. Anyway, it takes too long to recapture the cost. So majority loans that are made today are at 0 points. Now, the lender will have a flat fee of some sort, an admin fee or an underwriting fee, but that shouldn't be confused with points. So, you know, if I'm only requiring 1% from my lender I'm going to deliver a loan to, and I'm going to quote a 0-point rate, and then broker B over here has a 1.75% lender paid comp with the same lender, and they're going to quote a 0-point rate to the same borrower. Let's say we're both going after the same borrower. Well, it just follows, the math just follows that my 0-point rate is going to be lower than broker B, because I only need to get 1% to get
Mm.
paid. They want 1.75%. Well, in order to avoid any part of that 1.75% to be charged to the borrower, that broker has to raise the rate they're going to offer at 0 points. And that 0.75 point difference in lender paid comp, in most cases, is going to be worth about a quarter in rate. So if
Hmm.
I'm able to quote 6 1/8 for 0 points, because we're going to get paid 1% by that lender, and this broker over here is getting paid 1.75 by that lender, in order to quote 0 points, they're probably gonna have to quote 6 3/8, not 6 1/8. Well, that 1/4% difference over the life of the loan is substantial. So what it ends up meaning is if a borrower chooses broker B with that higher lender paid comp, they're going to be paying a higher rate. In other words, they're paying that other broker more, and they're doing it not through an actual fee, but through a higher rate. And so that's why we've been stressing a lot. The 1% lender paid comp that we have makes us highly competitive, not just with other brokers, but with major banks and with major national companies. Like, my favorite is Rocket Mortgage. A lot of people think, oh, Rocket Mortgage or an online lender, just by definition, they're going to offer better rates. Not necessarily. I can compete with them day in and day out, in part because our lender paid comp is lower, it's more competitive, and that means we're going to offer more competitive rates to borrowers.
So let me just kind of recap what I'm hearing to make sure I'm hearing this right. Again, as a homeowner, a potential customer, if I'm out shopping for a loan and I haven't settled on a particular lender yet, but I've talked to, let's say, 2 or 3 lenders, and I'm seeing a variation in the rate I'm paying because they've all probably said, hey, I'm not charging any points. There's no additional fees. It's just, this is my rate. And I'm seeing a variation. Can I then assume you called it your lender
Lender paid
compensation?
compensation.
Lender paid compensation is higher, so they've asked for more money versus the 1% you've had. Is that fair to go that way?
Exactly right. That's exactly right. That I would argue in most cases why, if a prospective borrower is getting quotes from 2 different mortgage brokers, and if they're both quotes are at 0 points, but there's a rate differential that's an eighth or a quarter or 3/8, maybe even a half, very likely that the difference in those 2 rate quotes is because one broker has set up with the lender a higher lender paid comp than what we're set up with, and that squirts out as a higher rate to the borrower. And so that's why I always stress this as much as I can. We're at 1%. We're doing that on purpose. We want to give you, the borrower, the absolute best rate possible while still paying us a fair wage. And they're not paying it. We're paid by the lender, not by them directly. Now, yeah, they're paying it indirectly by the rate offered, but that just underscores more why what we're getting paid by the lender is so important to know. Because if you're getting another quote from another broker that's a higher rate, that's very, very likely because they have set up and required that lender pay them more than what we're required to pay from that same lender.
Now, I want to ask you another question. And this, if I'm overstepping, please let me know.
Okay.
If I let's say I am with another lender, I've had a quote from another lender, and I come to you, and your rate is lower, and now we've established that it's probably because of that, and I go back to that other lender, and they say there's no way they can do that. They must be misleading you. Are you by obligation, some kind of regulations, when you give me a worksheet and it says this is the rate, are you obligated to only give me, I don't even know if it's right, truth in lending? I mean, do you have to do that, or can you just put anything down there you want?
Well, yes and no. I mean, first of all, in the outset, when I provide a worksheet, it's not considered it's not a regulatory required form. Okay. It is a quote. But so as a consequence, you can run into a potential situation where a certain broker, another mortgage originator, may choose to put something on their rate sheet that they can't really deliver if the borrower says, yeah, I want to take those terms. I would say that's very rare these days. I mean, again, compensation is now highly regulated. I don't think that happens very often, but that doesn't mean, I mean, frankly, I had a recent example where I was accused of doing that. I had a refinance borrower, prospective borrower, who approached me, and it was an interesting case because they had an existing first mortgage that was an ARM loan, and they had kept it for the 10-year fixed period on the ARM. and then it just adjusted not long ago and went up to 8%. And then it also had a HELOC with, I don't know, $70,000, $80,000 balance on it. And they said they didn't need that anymore and they wanted to get rid of it. So I put together a worksheet and quoted them a rate. And it was based on a loan amount of around $550,000. And I emailed my worksheet and I offered them, and this was just a couple of weeks. In fact, this was just back when after the bad employment report a few weeks ago, when the 10-year bond dropped to 370. I offered them a cash out refinance, which those typically have a higher rate anyway, 6%, no points.
Wow.
And they were very excited about initially. But then here's what happens. They're hot to trot. Hey, we want to get an application going. Tell us what we need to do. Then I ended up having a conversation with this person who then challenged me a little bit and said, well, wait a minute, upon, more reflection, I was like, how can you do this? I'm like, what do you mean? She said, well, how can you quote this? I mean, nobody else is able to quote this. I'm like, well, who's telling you that? She said, well, on the news, I'm seeing that, rates aren't, I can't get this loan at 6%. It's like 6 3/8. And then they revealed to me that some mortgage broker like us, who they've used in the past, I guess they went to that person to get a quote too. And that person's quote was higher. And I think it was like 6 3/8. And she shared with me that this broker basically declared that my quote wasn't valid, that I was lying to him, that it must be some sort of teaser rate, that it's not for real. And I tried to reassure. I was like, look, I've been in this business for decades. I have no benefit by, bait and switching you. I'm not going to quote anybody anything because I'm doing it in writing unless it's valid and I can deliver the goods. I can deliver these terms. In fact, I had pointed out that I can deliver these terms, but you got to, get your application in today, and I can lock it in up until almost midnight that night. It was a Friday night. So I basically gave her the opening to say, if you want this, here it is. Get an application in. I'll lock it, and then I'll prove it to you. But they didn't believe me.
Wow.
And so that's the risk of being as aggressive as we are with, our quotes, is because from time to time, I'll get somebody, even a real estate agent sometimes will say, no, you're too far away from everybody else. How could that possibly be? You must be, lying, or you're not giving us a straight story. But, we can prove it very easily. In fact, once we start the process, it gets proven because part of the disclosure process, the borrower is going to know what we're getting paid by the lender. It's part of the disclosure process anyway.
So it's real easy then for someone, again, going back to, hey, the simple mind of if I see a difference of rates being offered, it has to be, most of the time, it's a lender paid compensation program. It's not something I'm paying in advance. It's something that says, hey, you as a broker have negotiated those terms and said, for me to do this loan, this is what I'm willing to make as a fee. And then that fee is what really determines the rate that can be offered. Yes?
Correct. That's a very good way to put it. Now, there'll be slight differences from lender to lender that we all deliver our loans to, but that's very slight. Most every lender, all the lenders, all these loans get delivered ultimately the same end source: Fannie Mae, Freddie Mac, Ginnie Mae. So there's not a whole lot of variance among lenders. So really, where you see the greater amount of variation from, originator quote to originator quote is going to be based on their comp. And some of us who, some people who do what I do, they require getting paid more than I require. And that's just a different style. There are people who do what I do, that they're not all about getting as many loans as they can, being as competitive as they can. They're all about getting as much income on a specific loan, individual loan. So they're willing to do fewer loans, but make more money per loan. And sometimes it's just because they don't want to handle a bunch of volume. They want to do a few loans a month and make a good living. And the way you can do that is set up your lender paid comp for a much higher amount, figure out a way to sell that to the borrower. And if you're successful, you could do 2 or 3 loans a month and make a decent living. I don't like that approach. I never have. I'm all about every prospective borrower I touch. I want to help them and I want to get that loan, and I want to make sure that what I give them is as attractive and competitive as possible.
Well, Art, I appreciate you clearing this up. I don't have any question marks above my head now. I understand. Also, I understand as I look at your rate grid, that is just how do you describe it? That's a guide, right? It's not
Well, I
a,
call
it's,
it, yeah, I call it interest rate indications,
yeah, there we go. Okay.
because every rate type that you see on our grid, it's based on certain parameters. And that's why, again, I'll remind people, definitely check out our About Rates link at the bottom of that grid, the bottom right, because I go into great detail about how, when I get a call about what's the rate today, and I end up having to, not answer the question right away because I need more information to answer the question. So in that link, I go into great detail about how all that works, because it's a combination of different factors. It's what's going on in the financial markets, and then what is the specific parameters of this borrower's inquiry in terms of all kinds of things, the type of property, their credit score, their down payment amount, and so forth. So all that goes into the rates that are offered to a specific borrower. The grid basically has certain basic assumptions, and then that gets fine-tuned once I've talked to a borrower and get to know their specific situation, and then I can give them another quote that's more specific to them and what they're trying to do.
Yeah, in fact, I went to your website and I watched. It looks like you've got a video on there now, and I watched that video. It says the same thing in writing, but it seems so much better when I watch you explain. It's like, oh, I get it now. I get
Yeah.
it now. So I appreciate that.
No,
Well, Art, I'll let you go. At the bottom of the page is also Art's information: 760-969-5023, or his cell phone number 714-612-9035. So when you're ready to make either refinance, get a new loan, remember what Barbara Corcoran says. It's true. It's supply and demand. If the demand goes up and supply doesn't change, guess what's going to happen? The price of that supply goes up. So I would say call Art today. Call him now. Make his phone ring while we're live, and say, "Hey, I'm ready to do something, and I don't want to overpay for the same loan from the guy or the gal down the hallway."
Yep.
And Art's your guy. So Art, I'll turn it back over to you. 760-969-5023, or call him on his hotline, 714-612-9035. Art, thank you so much. I appreciate it.
Okay, thanks, Jeff. Take care. Okay, everyone, we'll now go into our closing question from last week. As you know, that's a basic part of our program. Here's the question. We received a direct mail advertisement for a mortgage refinance, and it offers up to 2 payments to be deferred. It offers deferring up to 2 payments. Is this legit? This is an interesting question. I kind of chuckled at this when we got it. Short answer is, as you can see in the top bullet point, yeah, it's legit. And all it reflects actually is a long-standing, been around forever. It's a mortgage refinance trick of the trade. And what it underscores is, if you're going to pursue a refinance, and I say refinance, by the way, because refinance is where a borrower really has some control on the timeline of your transaction. If you're in a purchase, a whole different ballgame. You don't necessarily have any say on what time of the month you can close, based on what you negotiated with the seller as to the escrow period. But when it comes to a refinance, you have the ability to basically, time your closing to help take advantage of this potential deferral of 2 months payment. So that's why I say timing is everything. And the fundamental basis of why this can, help you in terms of skipping 2 monthly payments is because of the fact that with mortgage payments, interest is paid in arrears. It's not paid ahead like rent. If you make a rent payment on September 1, you're paying for September. If you're paying a mortgage payment on September 1, you're paying the interest due in August. So that's important key point to note when you're looking at the potential of deferring 2 monthly payments. So what you want to do if you're getting a refi, and I always bring this up, is you want to time your closing to be right around the 10th of the month. Why would that be? Well, again, that first of the month payment, you actually have, as most people probably know, a 15-day grace period. It's due on the first of the month, but you can basically pay it by the 16th and not incur a late charge. So I argue if you want to skip 2 monthly payments, time your closing of your refi to be right at around the 10th, maybe 11th, maybe 12th of the month, but probably no later than that, because you do need to allow enough time for the proceeds of your new refinance loan to get sent to your existing loan lender to get that paid off before the 16th of the month. Now, if you close on the 10th of the month on a refi, and if your first payment was due the first of that month and you haven't paid it yet, you have the potential of skipping that payment, which I would urge in most cases, that's a good thing to do. So that's the first part of skipping the 2 payments. Then the next thing to know is when you close a loan on the 10th of the month, and let's use September again. Let's say you close September 10th. The first payment on the new loan isn't going to be until November 1. As I put on the bullet point, the first payment on the new loan will be 30 days from the first of the month following the month you close. Again, if you close September 10th, you're going to pay prorated interest, prepaid interest on the new loan through the end of that month, but the first payment due on the new loan isn't going to be until November 1, 50 days away. So as a consequence, by closing on the 10th of the month, you can skip that first of the month payment due in the month you're closing, and then you're going to skip making a payment on the first of the following month after you've closed, because the first payment isn't due until another 30 days after that. And as I put there, voila, you've skipped 2 monthly payments. So a good question. Anytime you're getting a refinance, you should consider this strategy if you want to try to time it so you can, and this is one case where you do want to sort of time the transaction, if not time the market. Try to time it to where you can actually have that benefit of skipping 2 monthly mortgage payments, because from a household cash flow perspective, that can be a good benefit, particularly if you consider what time of year it is. Let's say anybody pursuing a refi now, this could be a good strategy to potentially skip a mortgage payment November 1 and December 1, which would be great as you're going into the holidays, because you're going to be spending more money for gifts and celebrations and so forth. So a good question. I hope that helps explain that little trick of the trade. And it is legit, and it's something you should definitely consider if you're going to refinance your loan. So with that, we'll go to our closing question for next week. And here it is. I remember when 40-year loans were available, and that's true. They were quite a bit about 15, 20 years ago. With today's higher rates and home prices, they would help with affordability. That's definitely true. Why aren't they common anymore? Well, that's a good question. Stay tuned for next week's Mortgage Minute, where I'll have the answers and then we'll be on the house. So in the meantime, I want to thank you all for watching and listening. Again, my name is Art Alvarez with Mortgage Works. So have a good weekend, and we'll see you next week. So long. Take care.